There we go. All right. I think we're live, Craig. All right. Right on. We got some folks here. All right, sweet. I think, can you all hear us? Pulverizer, Andrew, fun guy. Can you all hear us? This is, we got Craig Israelsen and me again. And we're going to, right now we're doing this on a quarterly basis, Craig. Is that kind of what we're thinking about?
Right.
Maybe more if the demand is high. So the last live stream we did, probably about 3 months or so ago, we had a number of views on that. And obviously this was of interest to the fan base, fans on the YouTube channel. So we want to do this on a regular basis, and we're just going to do it on a quarterly basis right now. But if we get good demand, we'll do it on a regular basis for sure. But Craig's going to talk about his Unbreakable retirement portfolio using his spreadsheets that he came up with, which is pretty fantastic. Craig, did you get anybody reaching out to you after the last live stream to inquire about it?
I did. Yeah, thank you.
Yeah, right on. That's fantastic, and I hope the people who used it will be here, and if people haven't used it, hopefully they'll get some information on that for sure. I do have a couple of questions on that myself, but Craig, welcome again, and take it away. I mean, whatever you want to do, however you want to proceed, it's up to you, man, for sure.
Okay. Well, I'm going to present press the present share screen.
This is not the 712 portfolio fund guide. This is what Craig. So you haven't been here. That's okay. But Craig, he's the guy from the 712 portfolio, but he has a spreadsheet. It's actually a software plan that Craig uses, and you can buy from him. It's not very expensive. To kind of run your own financial plans or retirement portfolio plans, if that makes sense. But it's not specific to 712 at all. But good.
Correct. Yeah. Are you seeing okay?
I think I got okay. So can you see that, Craig? I can see it. Can you see it on this? You're not seeing my screen, I guess. So we do see it. Yes, sir. Absolutely.
Okay. You see now I'm changing to the graphs and so forth.
Yep.
Okay. Great. Well, thanks to those who have joined. We'll take probably a little over an hour to review a couple of what I call tabs. All these little doodads here on the bottom are tabs. There's a tab. There's a tab. There's a tab. So there's not an attempt tonight to go through everything because it's rather in depth.
Greg, hold on. I'm hearing a background. Are you hearing any background noise?
I'm not.
It sounds like bacon is frying. You all hearing the background noise? Let me. I'm gonna hit remove real quick. Well,
I'll turn my volume down a little bit.
Yeah. So okay, gotcha.
Is that better?
Well, it's actually worse. We put the. Yeah, we were hearing
I'll keep talking. Is that any better or any worse?
Well, that's better right there. There you go.
Okay, great. So this is a Excel template, Excel spreadsheet that has been evolving over the past decade. And it now is at the point where I believe it's quite useful for people to do a lot of what if questions or test driving of their retirement portfolio. So in pink here, just a brief explanation. This spreadsheet allows you to test drive a retirement portfolio over multiple 25-year periods. And the reason we're doing multiple 25-year periods is so that we can get our arms around the issue of sequence of returns risk.
Exactly.
And, if we studied, for example, the period from 1974 to 1999, which is a 25-year period, we would be incredibly overly optimistic because that was a wonderful 25-year period. We can't cherry pick like that. We have to look at as many 25-year periods as possible. And the idea of 25 years, that takes a person from age 70 to age 95.
Yep.
And that encompasses a lot of us as we spend perhaps a quarter century in retirement or retirement mode when we're pulling money out of a portfolio. So to get a lot of 25-year periods, we have to go back a lot of years. And so this particular database goes back to 1926 and runs through 2023. So that's 74 25-year period. So that's almost 100. That's a 98-year period. And in that 98 years, you've got 74 rolling 25-year periods. So that's, I'm spending a little bit of time on this because that's kind of central to how the analysis is conducted. This is not Monte Carlo, right down here. Yep. Not Monte Carlo. This is not a simulation. These results are based on the user-defined portfolios, and you'll see what I mean in a minute, using actual historical returns of well-known stock and bond indexes. So to make sense of what you're going to see in just a moment, I just have a little, and for those who already are familiar with this spreadsheet, I apologize for this quick review. Consider that we're really studying 74 different people. The first person is Susan. She made her first portfolio withdrawal in 1926 and her 25th withdrawal from a portfolio in 1950. From Susan's 25-year experience, we can draw, she had 25 withdrawals, and we can calculate the average annual withdrawal that Susan took, and the actual ending balance of her portfolio. Then we go to Jamie. She's 1927, 1951. That's her 25-year period. 25 withdrawals, we calculate the average of those 25, and then we have the ending balance of Jamie, Andrew, Juanita, Connor, all the way through. So there's 74 different people. When we look at all of these average annual withdrawals for all 74, then we can calculate an overall average for all 74 retirees over all 25 years for all 74 people. So when we start looking at the average annual withdrawal, just keep in mind that that's an average of a lot of numbers, almost 2,000 numbers. And then the average ending balance after 25 years of withdrawals, that's the average, that's 74 numbers averaged. So I think that will give you just a little bit of a sense of where this is coming from. We're going to spend time tonight on this 1926 to 2023 period. But just be aware there's also another chunk of the program in a different tab, which looks at a shorter time frame from 1970 to 2023 right here. And if we have that time frame, which is over 50 years, we then have access to a few more asset classes or a few more indexes that have that history. We can move to 7 asset classes. As it is tonight, we're going to focus on 4 asset classes because we're going so far back in history to 1926. So we'll be looking at a portfolio comprised of large stock, US stock, small stock, bonds, and cash. And obviously, as you implement a portfolio today in 2024, you may use more than 4 asset classes. That doesn't undermine what we're doing here, because whether you have 4 asset classes, 6, 7, 9, 13, whatever, ultimately you're producing a return. And if we can simulate that return and the variability of that level of return using 4 asset classes, then we get the gist of the analysis. What I'm saying is, from 4 asset classes, we can learn a lot about how, say, a 10 asset class portfolio might perform going forward from today. So I'll skip the first steps tab because that's really useful if I'm not here talking you through it. I will just point out the top pink area here, and that is that the portfolio data tab and the retirement budget tab rely upon each other. Those two, here's the portfolio data tab down here. Here's the retirement budget tab down here. Those two are that's our focus for tonight.
Symbiotic relationship, essentially.
Yes, it's a very critical relationship And there's retirement budget tab. This is kind of the, I don't know what I'm going to call it, the missing link in a lot of software that's out there, but this retirement budget tab interfaces with the portfolio data. It has to. They have to interact. It took me a long time to figure that out. I was always so focused on the portfolio analysis. Then it dawned on me, but that has to be integrated to a budget that we have Social Security benefits incorporated. We have other income incorporated that's not being drawn from a portfolio. It took me a long time to recognize the obvious. I've been told that I have an amazing grasp of the obvious. Okay, so let's go to portfolio data.
You've been told that by your wife, I presume.
Yeah, and my kids. So probably the key thing to recognize as I'm going to do analysis as if it's you doing it, so you can get a sense of what is able to be gleaned from a tool like this. And I'll tell you up front, what's gleaned is confidence. You will have confidence in your portfolio so that we don't have to live in fear. That's the number one mantra. If we live in fear, no amount of money can compensate for that. So let's not live in fear. Let's be faithful, and let's get a sense of what history has taught us about how portfolios behave, and then say, okay, is it really going to be all that different going forward? And for all the people that have said, yeah, but this time it's different, time usually indicates, no, not so much. Variability is fairly consistent. In fact, this is a little bit of an aside, but standard deviation, kind of how we measure volatility of portfolios, standard deviation is very consistent. The standard deviation of any portfolio you want to build is very predictable. The returns year to year are very unpredictable, but the volatility, surprisingly, so it's a weird sentence, but volatility is the consistent thing. Returns are not in the short run. So with that said, let me pretend like I'm you and I'm coming to this tool and I say, okay, I want to get some confidence in my retirement portfolio. So let's use the current year of 2024. Everything in bright yellow is what you can enter, what you, the user, can control. So let's say we have a $500,000 portfolio. Our current age is 73, and we're going to start taking withdrawals at 73 because the RMD is making us. So I'm going to enter RMD down there because in that cell, that's where you enter the withdrawal method, whether it's a 4% withdrawal, the RMD withdrawal, a custom withdrawal, and I'll go through that in a minute, or a cash-based withdrawal. Let's just start with RMD because that's often what drives the withdrawal, and it just so happens to be linked now to the age of 73. So with those few variables in, we now have a chance to specify what our portfolio makeup looks like.
And Craig, the software will assume we're living till 98 here, right? 25 years of life expectancy.
It doesn't really make that particular assumption. It just assumes that you'll be making withdrawals for the next 25 years.
Right, absolutely. But basically 25 years of
withdrawals. 25 years. But I find a lot of people, as they use the software, they do the analysis, and then 5 years later, they do it again, maybe not 5 years, but whatever number of years later, and now it's the next 25-year window.
Right, okay, right on. Absolutely.
In other words, you can't really outlive the software because you can just keep updating the inputs. Because after 5 years of withdrawals, this person may have 600,000 in their portfolio. So 5 years down the road, they enter 600,000. If they made any adjustments in the allocations, they do that. You just kind of keep rolling forward with the analysis, but it is predicated on 25-year chunks.
Gotcha, right on.
So let's do this just for fun. Let's pretend that a person is super conservative. They have 100% cash portfolio. And if they have 100% cash, if it wasn't even in a money market mutual fund, let's just say it's in CDs, rolling CDs. Okay, then the total portfolio cost is zero. All right, that's great. If there's a financial advisor involved, which there shouldn't be in an all cash portfolio, that's not kosher. Then there's really no reason to enter the advisory fee, because this number right here in this cell, that's the expense ratio of the mutual funds or ETFs involved, plus the advisory fee if there's an advisor. So probably a more typical example would be, say, 50 basis points, 0.5%. So you'd enter minus 50. That represents 50 basis points of cost, 0.5%. But let's just go back to zero. And with those few inputs, an all cash portfolio, the RMD is driving the withdrawals. And the RMD, by the way, they're right here. Those are the percentages. So we start out at age 73. Let me blow that up a little bit. At age 73, your withdrawal is 3.77%. At age 74, 3.92, and so forth. And then you say, well, but if I run this forward in 5 years, if I redo the analysis in 5 years, no worries, just enter 78. And then 78, you come down, and these RMDs have adjusted. Now for age 78, that's going to be your withdrawal, 4.5% and 4.74. So this little data array table right here is live. It's living, it's calculating based on what age you enter. So we'll go back to 73 because that's the initial tee-off time for a retiree. Let me dial back here a little bit. Okay, all cash portfolio, $500,000 starting balance. That portfolio over the last, you can kind of see this little radar thing, this ping. That portfolio averaged 3.24%. Well, that's just cash. That's what cash averaged, and it shows that right there. Okay, cash averaged over the last 98 years, from 1926 to 2023, 3.25%, and a standard deviation or a volatility measure of 3.01%. So not impressive, but it's cash. And the question is, could an all cash portfolio survive 25 years of RMD based withdrawals? And the answer is actually yes. It's always yes, because the RMD is a percentage.
Yeah.
And when you withdraw a percentage from a portfolio, you really can't kill it. Exactly. You can drive it closer to zero, but technically speaking, a percentage based withdrawal method simply does not blow up a retirement portfolio, whether it's a 4% fixed rate each year, whether it's the RMD, a custom array. I know that Josh has done some interesting work on sort of reverse RMDs, which is, I actually wanted to talk about that for a minute. Josh may bring it up. It's a pretty clever idea because it synchronizes with how much money we will likely need to spend or want to spend early in our retirement when we have the health, physically, mentally, to do it. And I think that's often the logic behind a reverse RMD. And we can simulate that, and I can show you how.
Yeah, please. That'd be fantastic.
Where we start with a higher percentage and then scale it down over time as we are going on fewer cruises, going on fewer trips, all that. Okay, so this green box right here has to do with withdrawals. And the graph below it right here has to do with withdrawals. So the average withdrawal across all 74 people, across all 25 years that they individually had, was $29,000. That's the average withdrawal per year, average annual, that a $500,000 portfolio could sustain, assuming money is coming out because using the RMD. This graph below, I call it a graphlet because it's kind of small. this shows all 74 people, their individual glide path of their withdrawals. Think of it as 74 planes landing.
Yeah.
Well, what do you basically take away from that graph? What you take away is that if the dotted black line is the average first year withdrawal, most everybody had withdrawals that were escalating.
Yeah.
Well, not surprising. The RMD is an escalating percentage. But you think, well, but all cash, how could that sustain? Well, it really isn't so much about the cash per se. It's about the method. The asset allocation of the portfolio is, of course, relevant. But really, the driver here is how money is being withdrawn. Let's go to a 4% withdrawal rate.
Exactly.
Okay, now you see the graph change. Okay, now 4%, we have a different dynamic. Now the withdrawal on average is 21,000, but based on the graph, it gets up to 40,000 for some people based on the sequence of returns. Other people down here at the bottom of the graph, they didn't do so well because their 25-year window was during a time frame when cash returns were really low. And so that's why we're studying these rolling 25-year periods, is to get a sense of the range of experiences that you or I will have. So let's leave the cash portfolio. Let's go to 40% large stock, 20% small stock, 30% bonds, and 10% cash. Kind of a classic 60-40. 60% engines between large and small stock, and 40% brakes between bonds and cash. Now we see a dramatic increase. Let's go back to RMD as well. Okay, now with that portfolio, we're going to have costs. So let's say it's 40 basis points of cost. You use low-cost Fidelity funds or low-cost Vanguard funds or low-cost Schwab ETFs, whatever your flavor of choice is as to where you buy the ingredients for a portfolio. But I can tell you it's very straightforward to build a portfolio, a diversified portfolio for 40 basis points or less. That's not the rocket science part to this. That's easy. I was going to say skateboarding, but that's not easy for me. I usually wipe out on a skateboard. So the average withdrawal now just really improves up to 63,000. The range of experiences across the 74 different people is enormous. And just for fun, see, I highlighted with these little circles on the graph. This is that famous period from 1975 to 1999. I think I misspoke. I think it said 74. 1975 to 1999. That's an ideal 25-year window because you missed the crash of 73, 74 when equities got hammered. And 1999 was your last year. So you missed the tech wreck of 2001 and 02. Yeah. It's that perfectly sandwiched 25-year period. And this green line with those black circles, that represents the 25 annual withdrawals for that particular person. And they just skyrocket.
Yeah, crazy.
The 25th, look at that. The 25th withdrawal was $347,000. That's
a portfolio that started with 500,000.
It's a portfolio that started with 500,000. The average ending balance across all 74 people was 945,000. Again, remember, we started with 500,000. The average ending balance now in this blue area is 945,000. The graph below that shows the running experience of the end of year balance for all 74 people. In general, it's moving upward. All you're really looking for in these little graphlets is the directional thrust of the main body of the lines, the colored lines. Are the lines going up generally? In the green graph, that means that annual withdrawals are increasing over time. In the portfolio balance graph over here, are the lines generally trending up, going flat, going, heading down? Let me give you an example. If it's a 10% withdrawal rate, you can see what happens. The graphs ooh, now they're not really trending up, they're trending down.
Is that 10% adjusted with inflation or 10% of the previous year? You see what I'm saying?
Yeah, 10% of the portfolio's value.
Okay, gotcha.
Yeah.
Every year. It's 10%.
Every year. Yeah, you just look at the ending value and say, I'm taking out 10%.
Gotcha.
That's obviously pretty rough.
Right.
But every portfolio survived.
Exactly.
Our success rate's 100%. Our average balance, of course, got hammered. It's now 355. The balance did grow 13.5% of the time,
right,
which is pretty amazing. But 10% as a fixed annual withdrawal rate is not in that feasible range. 6% is actually in the feasible range. If you look at the blue area here, for a portfolio that started with 500,000 is a 60-40 allocation, 40 basis points of cost, and a 6% withdrawal rate. The average ending balance after 25 years across all 74 people was $1 million. So it basically doubled on average. Well, but in some cases, it way more than doubled. During that ideal 1975 to 1999 window, the ending balance was 2.8 million. Then here's an ending balance of 2.2 million. Then here's an ending balance down here of 457,000. So some people approach this software and say, I don't even want to look at the average. I just want to look at the worst case scenario. What was the worst case? Well, it's right here. It's at the bottom, 457. Wow, if the worst case scenario historically was 457, I'm just barely under what I started at, but I've been withdrawing money for 25 years. See, that's
6% of the previous year's value. I mean, so
correct. At a 6% withdrawal rate. If you go with kind of that classic Bill Bengen 4% withdrawal rate, then our worst case scenario is right here, 773,000. This is where the confidence comes from, is letting history give us a little bit of insight into what has been. And if you have 74 different rolling periods, we're not cherry picking. That's exactly what we're not doing. We're saying, if the average is useful to you, you've got the average. If the worst case is of interest to you, all you have to do is click on the detailed analysis tab down here. And that takes you to a more detailed graph. Let me make that a little bit bigger. And here you have the portfolio balance at age 98. On average, 1.7 million. We already saw that. The highest, 4.77 million. The lowest, 730. So if that's how a person wants to approach this sort of tool, then you have the lowest, the worst case result in terms of the balance after 25 years of withdrawals. You have the worst case scenario and how much was actually withdrawn in total.
Okay, so it shows you the total of withdrawals as well.
Total 20, yeah. How much, in other words, here's the 500,000. All these data right here are being dragged over from the main portfolio data tab. On average, you took out $1 million. On average, you finished with 1.7 million, having started with 500,000. But the worst case scenario is you took out only, quote, air quotes, 493,000, basically what you started with.
And you still had
730,000 remaining in your worst case scenario. So, and I'm not saying that, if a person's a pessimist, that's how they approach it, but the data are there if you want to look at it from that perspective, which is, if my worst case results give me a reason to be confident, then you're going to be pleased because you probably won't have that worst case experience. You'll probably have something closer to the average experience.
Question for you, just so I'm clear. So if we start the first year at 500,000 and we're taking 6% off, so that means we're taking $30,000 out. So let's say after year 2, the portfolio grows to 600,000. Now we're taking 36,000 out because we're still taking 6% of the. Okay, gotcha.
Right.
So then the following year, if it goes back to 500,000, we're only taking 30,000 again.
Correct.
Okay, gotcha.
Yep. And to that point, Let's go back to the portfolio data tab. Actually, I lied to you because now I clicked on detailed analysis and I said I wasn't going to do that. But it's so hard not to because there's so much fun data there.
100%.
So one of the pushbacks when we go to a 4% or a 5% or any percentage-based withdrawal rate is that the portfolio, because it's based, the withdrawal at the end of each year is going to be based on the end of year portfolio balance times whatever the withdrawal rate is, 4%, 5%, 6%. Well, as Josh just pointed out, some years the portfolio has a negative return. And if you want to get a sense of that, click on annual returns. And the annual returns gives you the detailed data for all 4 asset classes from 1926 through 2023. You know, this is the visible V8. If you made that model back in the 1970s, you know, that plastic V8 engine, everything's visible. The graph up here is the year-to-year results of that 60-40 portfolio, and it had positive returns 76% of the time. Well, that means it had a negative return 24% of the time. That's true, shown by the red bars going south. Well, but that's pretty impressive to have a batting average of 760. You know, the baseball, that's the baseball analog of 76%. And even accounting for those negative years, we have these really incredible results of nearly 1.8 million average ending balance
100%.
from a start of 500,000, an average withdrawal of roughly 44,000 if you round up a little bit. 70% of the time, the portfolio withdrawals kept up with inflation, and 64% of the time, the withdrawals increased year over year. So that's the rub right there. A person says, whoa, that's what bugs me. 64% of the time, that means, let's just round it up to 65. That means roughly 36% of the time, my portfolio withdrawal will decrease.
Right.
That's correct. Click on detailed analysis and go up here to this upper right-hand corner. 36.3% of the time, the annual withdrawal decreased the following year by an average of $2,900. So what has happened historically is that advisors or whoever, you know, just in the process of conversation, there has been this acknowledgement and hand-wringing over the fact that the portfolio withdrawals do in fact decrease sometimes if you have a percentage-based withdrawal, which of course the RMD is, but of course the RMD escalates. The missing link often in that conversation was, okay, but how much is the decrease?
Right, exactly. And if it's $250 a month, that's what we're talking about here. $250 a month. Oh, wow.
Yeah. If it's not a material, now that's the average decline. In 2008, that decline would have been larger.
Right.
Well, for sure. But that's why people have cash in their portfolio, and they just dip into the cash and then replenish it. There's lots of ways that we deal with that.
Well, not only that, Craig, is that okay? But guess what? 2/3 of the time, sometimes you got a massive pay raise when your portfolio jumps. So not only did you have to, you might have to adjust your portfolio down where you're spending downward 1/3 of the time, but 2/3 of the time you got to adjust your spending upward, and that's what's starting. I can't remember what we started with, 6% or 5%. I can't remember, but that's what's starting at a pretty good premise that you're saying. Kind of going back to my whole concept of the reverse RMD. That we're saying we're going to take more from the front end to enjoy it while we have our health and we got our loved ones and all that.
Yep.
And if I'm 82 years old now, I got to adjust it by $300 a month downwards. Well, hey man, that's okay. I had fun when I was 68.
Right. Well, and here's the average withdrawals for all 25 years, right there. 22,000, 23,000, 24, 25. Remember, this is a 4% withdrawal rate. Okay. So those are your average numbers, and they're just continuing to go up.
Yeah.
And that's reflected in this graph right here. The green dots are the average withdrawal each year for all 74 people. The blue triangle is the best case withdrawal. That's a single individual. The purple diamonds are the lowest.
Oh, so that, okay, gotcha. So we're using the best, the average, and the low. Okay, I wasn't getting that when I was running.
Yeah,
okay, understood.
So this purple diamond, that's one person. This blue triangle, that's one person. The green dot is the average of all 74 people. And so again, you can look at it and say, okay, well, my worst case scenario, using the purple squares or diamonds, basically my withdrawals, they go up a little bit over time.
Yeah.
And you think, can I live with that if my average withdrawals have a slight upward bend most of the time? And I think, yeah, if that's my worst case scenario.
It looks like too, Craig, I can't see what it says, but in the middle there, in the worst case, it looks like it dropped a little bit from things. Yeah. So is that saying how much you took out that year? Is that what that says? Hover. Yeah. I can see it.
Yeah. So that one is year 13, and that correlates over to here. And that the smallest withdrawal in year 13 was $13,500. The average was $41,000. The best the individual who had the most ideal sequence of returns took out $71,000, almost $72,000 in year 13.
Craig, go to the worst at 13,000 and go to the year right before that. How much was that?
15,131.
So it dropped by $2,000 essentially from the year before to that year. You know, that's not, and yet at the end of the day, it's still the return, the withdrawals were still going on a northeast trajectory. I mean, not huge, but that's the worst of the 74 scenarios.
Right.
And yet it's still going up, and a couple of times went down, but that's the worst, the worst.
Yeah. And that's intended. We're looking at history to give us a sense what the future holds.
Yeah.
And if the worst case scenario doesn't freak us out, we're in good shape.
Yeah, 100%.
So let me now do a little fun thing for you. And that is this other block of yellow cells. This is the historical performance adjuster. This allows you to influence history. Do you want to be overly optimistic? Do you want to be pessimistic? In other words, the most common use of this adjuster section, let me make it a little bit bigger.
Yeah, there you go. Thanks.
Right here is to discount bonds. Let's say I'm going to say that bonds, well, let me go back to zero. So historically, the aggregate bond index over the last almost 100 years has averaged a 5% return right here with a standard deviation of 5.86. Large stock has averaged 10.28%, small stock 11.02%, bonds 5, cash about 3.25. So that's actual history using actual indexes. S&P 500, Russell 2000, Bloomberg, used to be Barclays, aggregate bond index, and 90-day treasury bills. What if you said to the program here, yeah, I understand that, but my view is that bonds going forward won't do as well.
Yeah.
Fine. If that's the view you want to impose, you can impose it historically. Because again, we're using the shadow cast by the past into the future. Mm-hmm. So if you want a different shadow, you have to change the past. So that's where this adjuster block comes in. Yeah, I enter minus 200. That says I want 200 basis points or 2 percentage points reduced from the historical return. Now the question is, does that kill the portfolio?
And the standard deviation is set, though. We're not changing. We should not change that.
It doesn't. Yeah, it doesn't affect the standard deviation.
Good.
Interestingly.
I like that. I like to keep the older standard deviation. So I like that a lot. So yeah, right on.
So does that kill the portfolio? Because you have 30% of the portfolio now in a asset class that you have reduced by almost half. Well, the average withdrawal, let's go back to zero here just for a second. So our average withdrawal was, call it 44,000, and our average ending balance is 1.8 million. So let's just kind of lock those in our head. 44,000, 1.8 million.
44, 1.8. Gotcha.
Let's do this. Take 250 basis points off of bonds.
44.
Now the average withdrawal goes to 40, just under 40,000, and our average ending balance goes to 1.5 from almost 1.8. So definitely noticeable, but does it kill your plans to be happy in retirement? Nope, sure doesn't. It simply is almost impossible to kill. I mean, let's take 300 basis points off that, 300 basis points off small stock, 100 basis points off cash. Now we're down to about 30,000.
So it's 44 before. So now we're okay.
So it's a material impact, but our average ending balance is just under $1 million. Again, we started with 500,000.
Right.
You're going to have money left.
Right. 100%.
What if we go to RMD?
And that was before with a 4%, Craig? Is that what you did?
4%. Now we go to RMD with a dramatically impacted history, which is obviously changing the results. Basically, what happens if we alter history dramatically, we go to RMD, we still have on average, after 25 years of withdrawals, about what we started with.
And what's our average? I can't see what the average withdrawal amount is.
The average withdrawal amount's about 42,000.
So it's 2,000 less.
So that's RMD now. We're using the RMD. In other words, we're just thinking of all the ways we can try to kill this portfolio, and we can't do it.
Make it 6% instead of RMD.
Okay, 6%. Now we have an average ending balance of 570,000.
More than we started with. Yeah.
It's really, really hard to kill a portfolio, even when you try to. So let me show you how to actually do it. If you're determined to kill your portfolio, I'm your guy. I can show you how to do that.
You're the portfolio killer, hey?
I'm the portfolio killer. So let's enter a 0, and that opens up these additional cells. Let me kind of blow this up a little bit so you can read things more easily. So if I entered 0, where previously I'd had RMD, or I'd had 4% or 5% or 6%, by entering 0, it opens up this block right here. And now we can enter cash-based withdrawals. So,
hold on, Craig, I got to wait a second. I guess this is pretty funny. You said you're the portfolio killer. My man Scott says, no, Kamala, she'll kill that portfolio deader than a Doordale. So don't get, you don't have to laugh. I don't want to bring politics to this, but that was pretty funny.
So I'll leave it alone. But so we've got, right now we have $80,000 entered. Okay, well, that was
I'm sorry, Craig. I missed that. So say it again. What have you done here?
Well, let's go. Okay, let's keep it at 500,000. Okay. And already in there was 80,000. Well, that's a 16%, the equivalent of a 16% withdrawal rate. That's nuts.
Where did you put 80,000? Okay, right there. Gotcha. Okay.
Yeah. So 25,000 is now how much we're withdrawing each year. That represents a 5% withdrawal rate.
Right.
So what's different now is I'm entering an amount of money. I'm not entering RMD, which is percentage. I'm not entering 4%, which is obviously a percentage. I'm saying to the history, to the portfolio history, I want a fixed amount of money, and I want it to grow. I want it to grow, in this case, by 3%, a 3% COLA.
Yeah.
Now, because we're smart, we have an option in reality, year to year, as we make these decisions, to not stick to a 3% COLA. So what this next section allows us to do is to specify sort of guardrails.
Yeah.
If the annual portfolio return is blank or lower, okay, let's put 0. 0 or lower, that means, in other words, if the portfolio return is negative, if it's below 0, then my COLA is 0.
Okay.
If my portfolio return is blank or higher, let's put in 10%. If my return is 10% or higher, I want a 6% COLA. All right. Okay, so now we have kind of a smart thing going on. We come back up to the results, and that says, okay, well, my average withdrawal was 42,675. That's good. My average ending balance was 1.6 million. Great. My portfolio grew 88% of the time. My success rate, I don't know if you noticed before, but when we were using RMD or 4% or 5% or 6%, the success rate was always 100%. It always will be.
Yeah.
Now it's less than 100.
Yeah.
Why? Because I've gone to a system that says that this withdrawal can never go down.
Yes.
It's 25,000 or higher based on what the portfolio does. But I have a zero COLA if my portfolio is negative. Well, a zero COLA still means that my withdrawal doesn't change.
Yeah.
It can't go down. That's how you kill a portfolio. Let me demonstrate. Let's go to 35,000. And now my success rate is 55%. That means 45% of the time you killed this portfolio. As demonstrated, when these lines in this green graph, when they dive bomb, that's a kamikaze right there. That's a kamikaze experience.
That's what that means. Okay, gotcha.
Yep. When those lines dive down to the zero, that means in that year, so in year 12, that's how soon you killed the portfolio. So one of these 74 different people, they were out of money in year 12. Another one was out of money in year 13, and so forth. That's how you kill a portfolio, is to set up a hard dollar withdrawal method. Even though we have a smart COLA going on, smart COLA meaning, if you have a negative return, you don't impose a COLA. But what can't happen is that you're not allowed to actually withdraw less money.
Right.
And that's what kills a portfolio. So if you're comfortable with say a 4% withdrawal rate, knowing that roughly a third of the time you'll have a modest decline in your withdrawal, then you send that success rate to 100%. That's the trade-off. And it's a really, really key thing to realize. And it may not work for everybody. They may want an annual withdrawal that's guaranteed to be the same or higher.
Yep.
Okay, then you have to be really careful about how much you specify, what's your starting. That puts a lot of pressure on your starting number, the starting amount you withdraw. And so anyway, just as a point of, I guess, caution, a new feature.
Hey, Craig, just real quick, what's the green? I can't see my point. The green in the middle there, that box in the green. So next to the blue box, go up a little bit. There's like three. Yeah, right in there. What is that?
Oh, that's okay. That's a good transition. So that's the estimated total accumulated capital after 25 years, 2.3 million. Okay, that's dependent on the retirement budget. So let's keep our promises and let's go to the retirement budget right here at the bottom here. Okay, retirement budget. This is very individualized. Everyone who uses this program, I shouldn't say that, I don't know that. A good friend of mine who uses it, he spends most of his time in the budget.
Okay.
So the first thing you enter is your Social Security information. So you have yours. Let me blow this up. You've got your estimated Social Security monthly income, and that's very easily obtained from the Social Security website. And then the spouses, if there's a spouse. Okay, let's just leave these numbers as they are. 3,500 for you, 1,750 for the spouse. When do the benefits begin? For you, they begin right now. You're already in them, let's say. For the spouse, they begin in 5 years. You enter 5 right there, or 4 years later, or 3 years later. That way you can stagger when they start. And this next one's kind of weird, but if for some reason you knew that benefits were going to end, which I can't actually think of a scenario, but I felt like I had to program it in. If they end at year 20, let's say you're going to die in 20 years. I don't know how you know that.
Gotcha.
Anyway, if they never end over the 25-year span, just leave it at 26.
Okay, got it.
And that gives you all of the annual
Okay.
Social Security monthly benefits. The COLA, you also enter. What do you think the COLA will be for your Social Security benefits? And that's just up to you. Right now, it's at 2.5%. If we enter 2, then all these numbers adjust accordingly. Then we come down to estimated other monthly income. Are you going to be earning money or accruing money through rental income, annuity income, whatever the source is? Other is a huge catch-all. If there's none, then just enter zeros. If there's some amount, enter that amount. Let's put $1,000 monthly. Let's put that in for all 25 years. We have stipulated a 4% withdrawal rate. That's coming from the portfolio data tab right here, 4%. So that's where this portfolio data is now being integrated into your actual budget. Here's the withdrawal rate from your portfolio, and here is the average monthly portfolio withdrawal. In other words, Social Security income for you in that cell, Social Security income for a spouse in that cell, other monthly income for you collectively as a household in that cell, the average monthly withdrawal from the portfolio in that cell. That's not in bright yellow. Everything in yellow, you enter. This is in blue. That means it's coming from what's called the dashboard inputs. Think of the portfolio data as a, quote, dashboard. So as your withdrawal rate changes, that will change. 1839. Let's go back to here, enter 5%. It was 1839. Now it's 2299 in that cell. So this information is live based on how you are specifying that money is being withdrawn from your portfolio. All of that leads to this number right here. Estimated total monthly gross income from all sources, $6,799. That's your Social Security, your spouse's, other income, and then your estimated portfolio withdrawal. Gives you that number right there. Well, there's a complicating factor, and that is if the RMD is involved, you are then forced to withdraw money. There's the withdrawal, assuming RMD. But this column now, column K, opens up. You didn't see this before, but now you do. Because some people, even though they have to make the RMD withdrawal, they don't actually spend it. They reinvest it into a savings account or a brokerage account or somewhere. So this allows you to then enter how much of this RMD withdrawal right here you're going to reinvest. You're not going to spend it. So let's say it's 1,000. Of that 1,572, you're not going to spend 1,000. And then you could go down and enter accordingly. To kind of speed things up, I'm just going to enter a formula. That number times 0.8, you're going to not spend 80% of whatever the withdrawal is. So that's just an easy calculation you can just program in yourself, meaning you're going to spend 20% of your RMD. Mm-hmm. Well, that RMD has that unspent or reinvested RMD has to go somewhere. And up in this cell right here, that allows you to specify what the interest rate is on that reinvested RMD. Right now it's at 3%. We'll just leave it there.
Yeah. That
gives us then a total estimated gross income. I'm just reading from right here from all sources, 4814. Well, that number went down because, if we go to 0, you have more money to spend. But we're reinvesting. If we're reinvesting it, we can't spend it.
All right.
So this is the gross monthly retirement income, or in other words, spendable income, all the way from year 1 through year 25. The monthly average, 8,556. Then you have an opportunity in the bright yellow. How much of that is taxable? Right now, we're saying all of it's taxable. Okay. What's the tax rate? Right now, it's just hardwired 25%. If you want to make it 30%, or 15%, whatever you think is going to be, you just enter that. Again, anything in bright yellow, you can enter. That's for you to decide. That then gives you net monthly retirement income minus taxes and minus reinvested RMD. So that's $32.96. Then we need to estimate how much your monthly expenses. How much do you need in retirement? Well, right now it's $7,500 a month. Well, that's not going to correlate with the numbers that we're seeing prior to this. So let's put in 3,500, and we'll just copy that all the way down. What that says is, if you need $3,500 a month, right now, estimated for year one, you have $32.96. So you have a monthly deficit of $204. Not a huge deal, but you do have a deficit. In year two, you have an anticipated deficit of $160 a month. Well, what's driving that is that the spouse's Social Security is not kicking in until year three. That's driving these deficits in years 1 and 2. If the spouse starts the same time you do, that deficit over here goes away. So those are all things that obviously you control based on your individual circumstance. All of that information so far has been based on monthly. In this section right here, let me blow it up a little bit. This section right here it just annualizes the monthly data.
Gotcha.
So you have an estimated net annual income of $55,000, needed income of $42,000 based on 3,500 times 12, and now you have an annual surplus or deficit. Okay, in the bright green is the cumulative budget surplus or deficit. And again, this took me a while to just sort of think through the obvious, that if a person has a surplus in their budget, it has to go somewhere.
Right.
Well, and I'm not even assigning an interest rate to it. And so this is lowballing.
Right.
So this says, based on what's been entered, with these surpluses that you're producing annually, that ends up to be $609,000 after 25 years.
With no interest. With no interest.
Yeah, with no interest being assigned to it. The retirement portfolio itself is estimated to be $945,000, and that comes from right here. There's that 945 we saw in the dashboard. It now shows up down here at 945, but here's the pathway to that 945, the year by year estimated balance in the retirement portfolio, plus the reinvested RMD. So you have the bright green, your budget surpluses or deficits, the blue, your portfolio, retirement portfolio, and then the sort of mustard color
combination,
the RMD reinvested. That number right there, 609 plus 945 plus 1.6 is 3.19 million, which I'm in the bright purple. That's what or maroon. That's what I'm suggesting we call the estimated total accumulated capital, 3.194. That's that number right there.
So that RMD reinvested was a 3% interest rate you're giving it? Okay, got it.
Yep. So that's
so if you gave that 0, it'd be whatever the thing in the green was.
So the thing here, this is a budget surplus accumulator, and the RMD will be a little bit different.
Gotcha. Okay, understood. Because you're spending 80% of the RMD. Okay. Gotcha.
So if we assign a 0 to the reinvested RMD, then we have 1.2 million is the balance. Now we're down to 2.8 total capital. And that shows up in kind of a shorthand right up here. So we've got the portfolio itself at just under $1 million, but in terms of budget surplus accumulated over time, plus RMD reinvested over time, that moves the total capital to well above the portfolio balance itself.
So if you're just spending all of your income from Social Security and the RMDs, you just put, what do you put in the the budget there? You put 100% instead of 8.8, you put 100%. Is that what you do there?
Okay. So you would come over here, and the reinvested RMD would be 0.
Okay, gotcha. Right.
And I'll just copy 0 down all the way. And then at that point, it doesn't matter what interest rate I assign because there's nothing being invested. So that maximizes my monthly income all through retirement. And that is going to send the reinvested RMD account, of course, to 0. And now we have 2.8 million remaining.
Is there a way to keep the like this green column there, Craig? Is there a way to equate that so we're just whatever money comes in, we're spending it, there is no surplus? Is there a way to just equal those?
Yeah, that's a good question. The only way that one would achieve that,
just kind of manually go in there and
at present, you'd have to, well, the easiest way is just to, in these bright yellow cells where it says enter your monthly expenses,
right,
just press equals and then go grab that number.
Okay, gotcha.
Just go grab what is the net retirement income.
Okay.
And it just automatically says, okay, if that's your income, you're going to spend it. You're going to have no surplus or deficit ever.
Okay.
In which case, the only thing, then the only accumulated capital you have is the portfolio itself.
Oh, right on. That's good. All right, appreciate that. That's one thing on my reverse RMD. I was having a hard time. I was wanting to spend all the income. I was like, I was having a hard time figuring that out. So that was it right there. Absolutely.
Well, let me show you now, since Josh has brought it up. I want to show you one additional feature. In this cell right here, it says guaranteed return.
Yeah.
This is a new feature.
Oh, sweet.
Right now it says no, or N. If I enter a Y right there, whoops, then these cells black out for the allocation cells to large stock, small stock, etc. And this cell opens up, and I'm given the instruction, enter the guaranteed portfolio return in cell C18. Well, this is cell C18 right here where the 6 is. So if you are looking at buying an annuity,
right,
it's a guaranteed annuity at, say, 5%. Okay, you have 500,000. You have a 5% payout each year on that 500,000, and you're taking money out by virtue of the RMD. Okay, what does that produce? Well, what that produces is a average annual withdrawal of $30,000, and an average ending balance starting at 500. Average ending balance is 272. And so as you look at this graph, at about year 10 or 11, your annuity principal value goes below the starting value, if that's how the annuity is set up.
Right.
So I don't know how often that'll be useful to people, but that was based on user input. Let's go back to no on that one. And I want to show you a way to do this reverse RMD, because I think it's quite realistic, actually. You're going to type in the word custom. So you'll notice that cell C22, this cell right here, that's a real key cell, because you either enter 4% withdrawal rate, RMD, 0 for custom, for cash-based, or the word custom. And when custom is entered, these cells open up down here. This is where you would then enter individual annual withdrawal rates. And I already preceded it, knowing that this would probably come up. And so it's not the RMDs in total reverse.
Right.
But it starts with 6% for 5 years.
Yeah.
Then it goes to a 5% withdrawal rate for 5 years. And then it goes to 4% for the remaining 15 years.
Like it.
Okay. And then we'll look at the results. So the average annual withdrawal is 41,774. The withdrawals increased year over year about 59% of the time. They kept up with inflation about 27% of the time. The average ending balance was 1.5 million. the balance grew 100% of the time, which is interesting. And of course, your success rate was 100%. You never killed the portfolio.
And in fact, the portfolio is triple the size of the initial starting balance.
Correct.
That's crazy.
So to get a real, a more granular view of how this plays out, we have to go to detailed analysis. And here's the withdrawals by year. And so they go in stages.
Yes.
So here's stage 1 when we were doing a 6%. Here's stage 2 when we were doing a 5%. And then here's stage 4 for the last 15 years.
I love that. That's fantastic. That's a great visualization right there, Craig. Yeah,
and that achieves, in all likelihood, what the person was trying to achieve, which is, I want to start out of the gate a little higher. And really to simulate that, I think we've underestimated. Let's go to 8%.
Yeah, exactly. 8, 100%. 8, 6, and 4.
8, and then go to 6, 6, 6, 6, 6, and then go to 4.
Yeah.
Okay.
Yeah.
And you can kind of see it here when the graph has these bend points.
Yep.
That's really sort of indicating what's happening. But ultimately, these little graphlets, we're looking at the general thrust, which is, are they dive bombing, or are they going down and then recovering, going down, recovering, and then heading back up? Well, that's in line with what we've told it to do. We're saying, right, I want heavy withdrawals out of the gate, but then I'll back off, go to detailed, and it's a more pronounced pattern in the green dots, which is the average withdrawals by year. Probably more helpful in the data table. The average withdrawal in the first 5 years is roughly 45,000. Then it goes to about 35,000, 36,000. And then in the last time period, it averages, as you can see, from 26,000 up to about 54,000. Ultimately, it's very difficult if you have a percentage-based withdrawal. Since the portfolio is growing, it's getting bigger. It's hard to have the withdrawals go down. Yep. They're pressured to go up if the portfolio is growing. And the reality is the portfolio does grow. So now the big caveat. This is the sort of unspoken, well, actually I say it here. Let me blow this up so you can really see it. Right here. I'm going to highlight it. Results are predicated on consistent adherence to the selected asset allocation model. What does that mean in normal language?
Can't change it.
Can't change it. So what it means is if you have a 60-40, that's what you stay with.
Yep.
We don't bail out. We don't chicken out. Why do we not chicken out? Because we've studied. Right. We've studied history and learned that there's no reason to chicken out.
No.
And I got to show you one thing. This is so cool. It's a three-dimensional contour map. Most people hate it. I totally love it. So, but you have to start with $1 million for it to display correctly. It's just a glitch. So I'm going to go to detailed analysis. I'm going to scroll over. This is the coolest graph ever. So this is the experience of all 74 people in every year. So in the leftmost graph, part of the graph, is the first retiree. And anytime you hit blue, dark blue, that means you're underwater. That means your balance went below the start.
Okay. Oh, interesting. Okay. Yeah.
So where did you end up? So the back wall, so this is obviously an XYZ graph. It's a three-dimensional graph. The back wall is where you finished after 25 years. Okay, look at how many retirees hit water. Yeah. They went underwater early on. But did they end underwater? Nope, never did. That's the whole point of this graph, is to show you.
I love that. People didn't like that, huh? Maybe they didn't know it because that.
Well, it's hard. It helps if somebody explains,
Yeah.
kind of how it's working. But anytime you hit bright blue, that means you went below your start balance, and that bothers people, understandably. But what happens if we stay in the boat? We stay in the 60-40 in this case. It's 60% equity, and that's going to have some volatility. Stay in the boat, and you'll get out of the water eventually. The other way to look at that is in this detailed graph, just to the left of the contour graph. This graph right here, this is in the detailed analysis tab. This graph shows the ending balance for each of the 74 people. Mm-hmm. This is their ending balance after 25 years of withdrawals. And so the average of all those is 2.59 million. Okay, but the detailed analysis says, but there's a lot of variability around that 2.59 million. This graph shows that variability. Right. The green dot is the balance after 5 years, or in other words, at age 78, because this is starting at withdrawals at age 73. Notice how often the green dot is below these little, I better blow it up here. You have these the maroon dash right here. Mm-hmm. Yeah. The maroon dash is the starting balance. All 74 people started with $1 million. After 5 years of withdrawals, the green dot says where they are. Well, during the Depression, which is this area right here, they went below. Yeah. The blue bar shows where they finished if they hung in there. Yeah. They didn't bail out. So now that you know what those mean, so the green dot, the maroon dash is the starting balance, always $1 million in this case. The green dot is the balance after 5 years of withdrawals. The blue bar is the balance after 25 years or 20 years after the green dot. Notice that the blue bar is always higher than the green dot. Yeah. That is a huge, huge realization. And it's essentially a different way of visualizing the water. The blue water is when you went under your start. There's different ways to graph results. And I'm employing two different techniques here. This graph here is probably more intuitive. And what this basically says is, if you have about in this case, a 60% equity allocation, it's really, really difficult to finish with less money than you started.
Never mind running out. You know what I'm saying? We're not running out.
Running out is really not a question. Right. And I don't think people may say, well, you're just being optimistic. No. I don't know if I'm being optimistic. I'm just looking at history. And if stocks and bonds and other asset classes.
I'm optimistic we're taking a percentage. I mean, that's the whole thing, Craig. It's like, you're taking a percentage. Yeah, taking a percentage, which means sometimes we have to reduce our income. But if the market is on a trajectory to the northeast, that means more often than not, we'll increase our income. And what we want to do in retirement is spend the money we saved. So
yeah. And bear in mind, these results right here, this is with the custom. Okay. This is the custom withdrawals.
Go. Start with 8%.
8% in the first 5 years. Let me blow this up. You've got 8% in the first 5 years, 6% in the next 5 years, and then 4%. That's an average withdrawal of 5.2.
I didn't realize that. Yeah, that's fantastic.
Yeah, and it's still a very good looking graph. If I go to RMD, and I don't know what people think, but it probably wouldn't surprise me if people thought, well, if you have the RMD, you're going to kill the portfolio. No, you're not going to kill it. This is what we know about the RMD. 95% of the time in a 60-40 portfolio, the blue bar was higher than the maroon dash. Or in other words, your ending balance after 25 years of withdrawals was higher than your starting balance. 95% of the time, you grew the nest egg. That's with RMD, which is a tough customer to deal with.
Exactly.
77% of the time, your balance was higher after 25 years than it was after 5 years. 77% of the time, I call this the hang in there stat.
Yeah, 100%.
Don't go 5 years, and in that 5th year, you have a scary experience.
Right.
You have a 2008, you have a 2021, you have whatever happening. Hang in there, because nearly 80% of the time, you'll get up onto the normal trajectory of what asset classes do, and you'll be glad you did. So probably the hardest thing for people to do, particularly if for people that came through the Depression, is to spend money that's in the pantry, so to speak. This portfolio that we've been modeling has 10% in cash. And it's probably hard for people to actually spend that after, or to withdraw from that after a year like 2008. But that's exactly why it's there.
100%.
It's exactly why it's there. And the other assumption is right here. In all of this analysis, annual rebalancing of the investment portfolio is assumed in the analysis. Annual rebalancing. So you're keeping it at 60-40.
All right, actually, good. So someone asked that question right here. So this right here, lucky one. Can you discuss rebalancing as it needed? So Craig, say that again, if you would.
So the portfolio, all the analysis in all of the tabs you can't see.
Right.
These are only the visible tabs. There's a whole bunch of tabs where all the grinding and welding takes place, all the calculations. I'm assuming that if a person specifies a 60-40 portfolio, in this case, that it'll always be a 60-40 every year. Well, to keep it a 60-40, you have to do some rebalancing. Otherwise, if you don't rebalance and stocks outperform cash, which they do over the long run, you'll end up with an 80-20, right, after 20 years, 25 years. So the simple way to think about that is when money's being withdrawn, you have, in this case, 4 asset classes, 4 investments. You have a mutual fund that invests in large cap US stock. So 40% of your money is in a large cap US equity fund or ETF. 20% of your portfolio, in this case, if it's $1 million start, you have 200,000 in a small stock fund. You've got 300,000 in a bond fund. You have 100,000 in cash. Well, at the end of each year, you have to decide where to withdraw money from.
Right.
In all likelihood, the most logical thing to do is to look at your portfolio and say, oh, my large cap fund did really well. Yep. So I'm going to take the lion's share of the money from that. Okay, that lion's share is essentially doing the rebalancing. Yeah. So you don't want to overcomplicate the rebalancing process. It largely happens on its own as you strategically withdraw money from the best performing funds. That ultimately is pretty dang close to doing the rebalance.
And that's actually, folks, what I talk about my barbell strategy is, Craig, I say this all the time. If the market goes up, you take it from the market. If the market goes down, you take it from cash. And that'll essentially make you rebalance ultimately at the end of the day. Craig, I just we're getting a number of questions about, can they get this from you? So I just want to make sure we tell people before people get off here where they can tell them about your sales pitch on what you're offering, if you don't mind, just while we got people here.
Well, Josh is very generous with his time to let me join him on these webinars. So this software, I normally sell it to financial planners. I sell it to investors for $200. But I have always and will always offer it to Josh's listeners for $100. So it's 50% off. And what that permits is you'll get updates through the year. So what I'm actually showing you is the August 15th. That's tomorrow. This is the August 15th release because it has a printout tab. This is new.
Oh, cool.
It's just a single page, easy to read printout right there. That's what the printout looks like.
Wow. Cool.
I just added that in the last couple of days, and I'll be sending that out to everybody who's purchased this Excel, this RPA, Retirement Portfolio Analyzer. I'll probably send it out tomorrow. So when a person buys it, they get updates during that year in which they buy it. So it's $100. And then if you want to buy it the next year, it's $100. I personally don't think a person has to buy it every year. I mean, I make updates, but the main thing that happens in January of each year is I add the next returns. And so at the end of this year, in January of next year, I'll add the returns for the asset classes for 2024 right down here.
Yep.
That'll go into the analysis, but that means we have 75 individuals that we're sort of, simulating. Is that going to dramatically influence the outcomes? No, it's updated. So if I were buying this, I'd buy it every 3 or 4 years, probably.
Some of my guys are engineer types.
They want it every. Yeah. So anyway, but I make updates to it. This is probably the third update this year, this printout tab. And the reason these happen is because I get feedback from users, and I try to incorporate that. So that's kind of the evolving nature of this, is that as people make suggestions, if I can program it. Some things are not really programmable. I just can't do it, but a lot of things I can do. So anyway, if you're interested, you just reach out to me, email
Craig
me.
at 712, is that what it is? Craig at.
Yeah. So
I'm gonna put the thing in here, but I'll put a link in the show notes when we're done.
Yeah, I probably should put. Oh, it's right here. So it's Craig at 712portfolio.com right there.
7 is the number 712.
Yeah.
Portfolio.
And I'm happy to, if people, what I have learned is that not everybody has a PC, and a common question for Mac users is, will this work on a Mac? And I think the general answer is that it usually does. If you're using Excel for the Mac, it seems to be fairly well behaved. I use a PC, so this has been built in Office, Excel, in Office, Microsoft Office, but on a PC. So for people that aren't certain if it's going to work on a Mac, what I generally do is I just send you
I'm on a Mac and it worked fine.
Okay. Yeah, but if a person's unsure, I just send them the software. They see if it works or not. If it does work on their Mac, then I just send a PayPal invoice and they pay.
And I use Google Sheets too to work. I mean, it worked fine. I mean, there's a couple small stuff, but it worked. So I was like, all right, that's cool.
Good.
So Craig at 712 portfolio, 7 portfolio.com, and I'll put the link, guys, in the show notes when we're done. So you just might have to circle back. Derry Bullock said a birthday present, 100. I tell you guys, $100, man, give me a break. You're not gonna go wrong with this. And then check Craig. This is nuts. My man Theo from Dallas Fort Worth. He decided to create a way to export his values from Right Capital, which is a financial planning software I use, into Craig's spreadsheet to give him a more realistic forecast. I don't like you saying that, Theo. That sounds like Right Capital is not realistic. How dare you? That's the kind of guys I got in this and who watch this, Craig. I'm like, well, how the hell did you do that? I don't know. But
well, I've learned, your listeners, this sounds like I'm trying to, please the choir, but I've done a lot of webinars over the years for a lot of different groups. And the kind of feedback I get, Josh, from your listeners is high level stuff. Yeah. And you say you have a bunch of retired engineers or current engineers. That's my view. Yeah. But even still, a lot of thoughtful questions, a lot of thoughtful response, feedback back to me. That's why I'm offering the discount, because I have a sense that you're actually using it.
Yes. 100%.
And I'm a teacher, but I've taught at the college level for 40 years. I really love it, when, quote, students actually come to class, do the work, use the stuff. So that's why I will always offer the discount to your listeners, Josh.
No, what I appreciate that, Craig. I was going to ask you something else. I think we had this question before from Libra. I don't know what we've gone through this before. I just can't remember. Libra Office. I don't know. Do you remember that answer to that? Does it work?
Oh boy, I don't.
I don't.
I don't. I need to keep better notes on what. Oh, I can go through my email.
It seems like some other guy piped in like two times ago, Craig, and said he didn't think it did. But don't quote me on that. But Tom, just reach out to Craig. If it doesn't work, we'll give you money back. I'm sure that's.
No, I'll just send it to him, and if it works, then I send the invoice.
Right. Okay, he'll send it to you if it works. So right on, absolutely, right on. I was gonna. All right, we have some questions on here. All right, so let me get my start questions. Carl says, "Does Craig have do you have a different portfolio recommendation now? He brought your spreadsheets last October. I'm not following that. Has Craig ever made a portfolio recommendation? I'm not familiar with that.
The software. I wonder if the question kind of pertains to 712, the 712 model.
Oh,
no, this tool is independent from the 712 model that I designed back in 08. This allows you to specify whatever allocation you want, whatever large stock, small stock. The question may be over here pertaining to the 7 assets. So this is a different tab. I said I wasn't going to show this, but here we are. So this is the 7 asset data. This adds non-US stock, real estate, and commodities. But the allocations are up to the user. In this spreadsheet tool, the RPA, I don't have a recommend.
Right.
Well, I say that. I don't. I mean, I have these cells pre-filled in just to have numbers there. But to the question, and it's a fair question, I would suggest that if you have a sort of normal sized, whatever that is, retirement portfolio, you probably need about at least a 50% allocation to equities.
Yeah.
If a person has $10 million and they have very modest expenditures in retirement, who cares what, right. You could be in all cash.
Right.
That'll be sufficient. So it's really hard to say what the ideal asset allocation is independent of how much money we're talking about. The more money you have, the less aggressive you can be. That's why I said like sort of a normal, like between 500,000 and 1.5 million, somewhere in there, you're probably going to need to have roughly a 50% allocation to what I call engines.
Absolutely.
Equities, real estate, that sort of thing. So that's the only recommended thing that I would have. And that's just based on my research over the last 30 years. And that's why I think try to make a point that once you start with that, all of this analysis, all of the numbers you see are then based on you stayed with it. You stayed with a 60-40. You stayed with a 70-30. You
stayed with 100% stocks and no bond. I mean, you know what I'm saying? You stayed with it. That's the
and you can certainly model that,
right.
And if you model an all stock portfolio, the numbers get big. Yeah. But look at the volatility. I mean, these graphs start to get really wiry. Yeah. It's more dramatic if we go 100% small stock.
Yeah.
Okay, but what you can't see is the y-axis. So the the range on this blue graph right here, let me really blow it up so you can see the y-axis. It's 0 to 25 million. Okay, that's 100% small stock portfolio. Right. You have almost a 5 million average ending balance. Right. But look at the volatility. Right. If a person can handle the volatility, I couldn't care less if you're all stock.
Right.
It's just you got to know yourself well enough,
and you got to stick it out You got to stick it out.
You have to stay with it.
You can't say I'm bailing in 2008. That's that. I mean, right. And like not just Craig saying it, everybody says it. You can't bail when the times get tough. And the nice thing about this software is that it shows you explicitly if you stayed the course, you would have been fine.
Correct. That's a big takeaway here, Josh. Exactly.
Our Roth withdrawals accounted for somehow. I'm sure I don't know, Craig, it seems to me you'd put it in as a tax.
So yeah, good. That's a great question. So when you have taxable and non-taxable accounts, you probably, the best thing to do is divide and conquer. Let's go back to the 40, 20, 30, 10, or 60, 40. Let's say you have $1 million balance overall. Your total retirement portfolio is $1 million, but 200,000 of that is in a Roth.
Yeah.
Then I would divide,
Gotcha.
enter 800,000 and do the analysis, go to the retirement budget, blah, blah, blah. And then do 200,000 representing the Roth. And where it'll change then is in the retirement budget. It'll be, and when you come over here to the income tax rate right here, it'll be 0. And then you'll combine those two printouts, and you'll have your macro picture, which is the combination of two separate runs.
Yep, that makes sense. And Carl, that actually goes to your question, what he's talking about. So Carl was saying essentially along the same lines. Should the Roth a little bit more aggressive than your traditional whatnot?
Yes, right. Yeah, that's right. Exactly. Your allocation may change accordingly. Yeah. That's the whole. See, once you start thinking that way, now you're thinking like an analyst. You're thinking like a portfolio manager, and a portfolio manager, whether they're Fidelity, Vanguard, and so forth, if they're managing a large cap equity fund, they're always managing a large cap. They don't go to 100% cash, because they're thinking long term.
Yep.
And so that's what I love, that question. I love that thinking, because that suggests that now we're really getting into the fine tuning.
Absolutely.
That the analytical mind naturally goes to once you see how these levers and pulleys, interact with each other.
And Random makes a good point. He says you could change essentially the tax percentage in column M to account for Roth withdrawals.
That's true.
You could. I actually kind of like the other way better, because then you can see what the Roth is doing relative to. It's kind of like I use my Craig. I'll have 3 buckets: tax, post-tax, brokerage accounts, pre-tax, and tax-free. And it's kind of we have these divided up uniquely for each. We don't want bonds in a brokerage account. Roth should be our high growth and stuff like that. And so. But you're right, Random. You could do that. You could reduce your effective tax rate in the column M. But I actually like what Craig did, where you have 2 different kind of accounts, kind of, and not competing, but working with.
Yeah, they're interacting.
That's what I'm saying. Absolutely.
And I do want to mention the next webinar we do, which I think is in, I don't know,
I think it's October. Yeah.
Okay, I'm gonna dive into the various time periods. These other blue tabs. There's a lot of stuff we haven't covered today. There's a new one called Sequence of Returns Analysis. It's pretty novel. I don't think any other software does it anywhere on the planet. That sounds very self-congratulatory, but I think it's very unique.
Well, you should though, Craig. If you're doing something no one else is doing, hell's bells, man. If you don't self-congratulate, no one else is doing.
My football coach used to say that.
I just, the funny thing is, Craig, you're obviously geeking out on this, and I say with all love, it's like, so these guys who buy it from you, I don't think they have to worry about Craig's gonna be gone. You know what I'm saying? I think that's what's cool, because there are some of these guys, like, I'm doing this course and then I'll never see it again. And I'm kind of guilty of that a little bit. I've sold a couple courses, but I didn't want to do it, re-update and all that stuff. I didn't want to do it. I just want to do it one and done. But you're obviously in this like white on rice, doing it all the time, which is pretty cool, because you're keeping it, you're keeping up to date, and that will go well with our schedule of quarterly meetings to see what if anything is up to date. But also these other tabs that you have, you only scratched the surface. When I was looking at it, I was overwhelmed. I was like, holy crap! And this here has helped me a lot, because I was like, oh, that's what that meant.
Yeah, there's a lot going on, and that's why I suggested to Josh a couple of months ago we do a quarterly. To assist those who've already purchased it, to kind of ongoing training, those who are new to it, to get a big overview. And I'm totally committed to this, because this software, originally it didn't have all these nice front ends, all these dashboards. It was just a huge database. And, just baling wire and duct tape, and where I knew everything was, but to anybody else, it'd be total mayhem. And I started building out these, I call them dashboards, just clean screens where you have hot cells. And then I realized, because I use this, I write for different publications, and this is my tool. This is one of my analytical tools. But then I realized, wow, this is a tool that everybody, I mean, people should have this.
Right.
Because, and I come back to where we started. Why should they have it? Because it gives confidence.
Absolutely, man.
That's why. That's my number one motivator. I love helping people. Again, I'm an educator. And I got to tell you, one of my favorite comments from a student was something to this effect. Yeah, I didn't really like this class, but I knew that you cared about us. I knew that you felt it was important. And so I thought, what the heck, I'll try it. Or, it was a personal finance class. But the idea was, I kept trying to emphasize to them, you can do personal finance or have it done to you.
Right.
And I want you to do it and not have it done to you.
And that's a great way to put it. 100%, man.
And so this program reminds me of that. Yeah. You can go in to this retirement window not in fear.
Right.
And that is such a driving force for me behind this.
Especially when you have all these idiots on YouTube like, oh, no one can retire. And you're just like, it's just not true. It's just simply not true.
They're doomed. They're doomsayers. And I really dislike it, these doomsayers.
And they're everywhere. They're like, the U.S. is going to crash. But we're going to be, I get so sick of that. I mean, look, all empires fall. It's inevitable. And we know if we just look at the good book, when Jesus comes back, it's not going to be peaches and cream. I'll tell you that right now. But in the interim, we don't just bury our heads in the sand. That's why we invest too. Just real quick, Craig, I'll get you out of here. But we invest because we expect our portfolio is going to grow. We don't know how much, but we expect it to grow, or else we wouldn't invest. So if you're investing, the idea that it's just going to go down, why would you invest in it?
Right.
Just go to CDs. It's okay. No one's going to yell at you. Craig's got a method here. You can put 3% a year, guaranteed with CDs. Be my guest. Most people invest because they expect, I think, 5 years from now it'll be worth more than it is today. In that case, we just showed you right there using historical data. It's like 3/4 of the time you had more than what you started with, and
But I think people have to get their hands into the data.
Yes.
Once you get your hands in the data and you tinker with it long enough, it begins to reveal the underlying message, which is percentage-based withdrawals. Yes. Percentage-based withdrawals are the key. Yep. Don't force these hard and fast cash numbers, hard dollar withdrawals. That's also a huge takeaway.
Could not agree more. All right, Craig, I can go drink some hot tea, man. God bless, much obliged. And like I said, folks, I'll put Craig's contact info in there. Just make sure when you reach out to Craig that you mention my name. Craig's not paying me, but I like the idea, and that's okay. I like the idea of you guys getting it half off. It just makes me look good, frankly. If obviously Craig and I have a relationship now. I consider Craig a friend, and that is due partly because of you guys, because you've reached out to Craig and had some wonderful comments and questions for him. And we're just a different breed here. It's just a different breed than what we'll find on YouTube, generally speaking. It's all right. All these guys say thanks, Craig, and appreciate it, man. God bless, and we'll talk to you here. Okay. We'll talk before October, but appreciate it, Craig. Thanks again.
Thanks again, Josh.
You got it. Thanks, sir. All right. Bye-bye.
Bye-bye.